every year, I think it's super important for all of us to keep up with the changes, particularly the contribution limit changes for our 401ks, our IRAs, and our health savings account, because these represent a foundation for most of us for our retirement preparation, for our retirement savings. So let's jump to the IRS website. And while the headline may not seem that exciting, if you're a little bit older, there's some big changes coming that you need to know about. Okay, so the article is 401k limit increases to $23,500 for 2025, and the IRA limit remains $7,000. But stick with me, because like I said, if you're a little bit older, there's some big changes coming. Okay, this catch-up contribution limit generally applies for employees aged 50 and older who participate in most 401ks, 403bs, government 457 plans, and the federal government's thrift savings plan. So that catch-up contribution remains at $7,500 for 2025. And therefore, participants in most of these plans can contribute up to $31,000 each year, okay? But under the changes made in the Secure 2.0 Act, a higher catch-up contribution limit applies to employees age 60, 61, 62, and 63. And this higher catch-up provision, instead of $7,500 a year, goes to $11,250. So the maximum an employee can contribute to their 401k. If you're under 50, is that $23,500 limit, which is the limit for a 401k. The catch-up provisions start at 50, but now there's a change for people that are over 59. So 50 to 59, the employee can contribute $31,000, and if you're 60 to 63, the employee can contribute $34,750. Now, I want to stress that this is how much the employee can put in, and your company contribution is in addition to this amount. So that's a big change. Another thing is the catch-up contributions. So this additional $7,500 or $11,250, depending on your age, it has to be made to a Roth 401k. In other words, you have to pay tax on that money before it goes in, if your wages were greater than $145,000. So that's important. So those are big changes. Now let's look at the IRA. Same article from the IRS. The limit on annual contributions to an IRA remains $7,000. The IRA catch-up contribution for individuals over 50 and over was amended under the Secure 2.0 Act of 2022 to include an annual cost of living adjustment, but it's going to remain $1,000 for 2025. So you can find this article at the IRS website, irs.gov, and the specific rule changes, the contribution limits, if you look up Notice 2024 for 2024 calendar year, -80. Okay, what about a health savings account? Health savings account is, as a financial advisor for over 20 years, the health savings accounts are kind of the trifecta. It's like if I was a congressperson, if I was a senator, God help us all, but if I was one of those, this would be the type of plan that I would want most Americans to be able to have. Why? Because you get to put money in, if you qualify, you get to put money in pre-tax dollars. It grows tax-free. And if you take the money out for qualified expenses, you don't pay any tax on the way out either. So you get all three benefits. For instance, with the difference between a regular IRA and a Roth IRA, with a regular IRA, we put money in pre-tax dollars. It grows tax-free, but when we take it out, we have to pay tax on it. So it's got 2 out of the 3 benefits. With a Roth IRA, we don't get the tax break on the way in, but it does grow in the account tax-free. And then if we comply with all the rules and regulations, when we take the money out, we don't pay tax on it. So again, it's got 2 out of the 3. But with the health savings account, it has all 3. We put the money in pre-tax dollars, it grows tax-free, and if we use it for qualified expenses and play by the rules, we get to spend that money, we get to take the money out without paying tax on it. Okay, but there is no free lunch. There's quite a bit of rules and regulations about this. And this information is from a Fidelity article that talks about HSA contribution limits and eligibility rules for 2024. We're mostly worried about 2025. So in 2025, the health savings account contribution limits are $4,300 for somebody that has coverage just for themselves, and it's $8,550 for family coverage. And for those 55 and older, there's an additional $1,000 catch-up contribution. As a reminder, that's not a big change from 2024. In 2024, the provisions, the amount that could be put aside instead of $4,300 in 2025, it was $4,150 in 2024. And instead of the $8,550 in 2025, it was $8,300 in 2024 for family coverage. And for those 55 and older, there's that same catch-up contribution of $1,000. Now, it's important we have to be eligible. Now, there is no income limit. The good news is, unlike IRAs, there is no income threshold above which you can no longer contribute to it. But there are other qualification, there are other eligibility rules. The main one is you have to have what's called the high deductible healthcare plan, HDHC, high deductible healthcare plan. And it has to have a deductible of at least $1,600 for an individual and $3,200 a year for a family. And its out-of-pocket maximum, including the annual deductible, cannot exceed $8,050 for an individual and $16,100 for family coverage. And to contribute to an HSA, you must not be enrolled in a health plan that's not an HSA eligible plan, which would include Medicare. So if you're on Medicare, if you receive Medicare, then unfortunately you cannot contribute to a health savings account because Medicare is not a high deductible health care plan, and you cannot be claimed as a dependent on somebody else's tax returns. Now, the good news is you have passed the first of the year to make these contributions to a health savings account. So as I'm recording this, we're getting close to the end of the year, but that deadline doesn't matter like it does with many other tax advantage accounts. The deadline that matters is when your tax filing deadline is, which in most tax years is about April 15th. So I want to end this video with talking about the difference between a Roth and a regular, either 401k or an IRA. I've already talked about the 2 out of 3 that benefits that you get. You don't get all 3 like you do with the health savings account. But oftentimes people think, you know what, a Roth 401k, a Roth IRA is always superior to a regular. And that's not necessarily the case. It depends on what your tax rates are going to be. You want to pay tax on that money when your tax rate is the lowest. So again, with the Roth, you have to pay tax when the money's going in because you don't get to put money in pre-tax dollars. But if you think your tax rate's going to be higher in the future, then you'd be better off paying the tax with a Roth at today's quote-unquote lower tax rate. Let me give you an example. Let's say that you have $10,000 that you want to save. With a Roth IRA, you're going to have to pay tax on that. Let's assume you're in the 20% tax bracket. So let's assume that you're going to be, of the $10,000, you can only put $8,000 in your Roth because you had to pay tax on it. 10 years later, let's assume it doubled. You got $16,000. So when you take that money out, you have $16,000 because you don't have to pay tax on it. But what about the reverse? What if you put that money in a regular IRA, a regular 401, let's do a 401k because it has that higher limit. You've got that $10,000. You get that tax, you get to put the money in pre-tax dollars, so you get to put in the full $10,000. 10 years later, it doubles and it's now worth $20,000, but you have to pay tax on that. Let's assume your tax rate's the same, 20%. So what do you end up netting? You end up netting the same amount, $16,000. So you want to pay taxes when you think the rate is going to be the lowest. So if you think the rate is going to be lower in retirement, then a regular 401k. This isn't financial advice. I'm not an accountant. I'm not a IRA specialist. I don't know your situation. But in general, it just makes sense. You want to pay the tax rate when the tax rate is the lowest. And so if you have a regular 401k, and you think your tax rate's going to be lower in retirement, you want to pay that tax rate in retirement. If you think that the tax rate is lower now and it's going to be higher later, either because your personal tax bracket's going to be higher, or you think the government's going to increase the tax rate, then you'd rather use a Roth 401k and pay the lower tax rate today and down the road not have to pay the higher tax rate. So I hope that helps. If it does help, making good decisions like this are important, and it's why I made this video up here, which are 8 things to think about stop doing in your 50s and 60s in order to enjoy your journey more. Another example of making good decisions and enjoying your time, enjoying the one journey that we get and being able to enjoy the youth of our senior years. 8 things to stop doing in your 50s and 60s in order to enjoy your journey more. I'll see you in that video. Bye-bye.